Right, let me think about making a gentle start this morning. There's quite a few little things that we're going to do today. We're going to start by recapping on deferred tax, which we were looking at yesterday. But I also need to cover things like intangible assets, things like investment properties, related parties, segmental. We've got quite a varied day. It's going to be a little bit choppy. Yeah. But the first thing I want to do is just to recap on where we left it, and this was on deferred tax. Now, we had looked at why we account for deferred tax. And the reason we account for deferred tax is matching. If we have a profit, we need to ensure that there is a tax charge in relation to that profit, even if no current tax is being assessed. So if you revalue an asset upwards, there will be no current tax liability. That liability has been deferred. So we need a taxation charge to match with the gain. So the reason for deferred tax is matching. How we account for deferred tax is a different question. We account for deferred tax on the basis of temporary differences. We take a balance sheet approach, a framework approach, where we look at the temporary differences between the carrying value of your assets or liabilities, and by carrying value I mean the figure in the accounts, and their corresponding tax base, the amount as acknowledged for taxation purposes. So when you revalue an asset, the carrying value of the asset goes up, the tax base remains the same, and so you get a taxable temporary difference on that gain, and you account for a deferred tax liability. If the carrying value of the asset goes down because of an impairment loss, then you've got a deductible temporary difference and a deferred tax asset. And I summarised that in 2 minutes, but we spent, 40 minutes, 45 minutes, nearly an hour last night just making that point across. I'd like to recap by summarising, by dividing a scrappy old page into two, because sometimes we account for deferred tax liabilities, and sometimes we account for deferred tax assets. Now, we account for deferred tax liabilities when there are taxable temporary differences. Typically, we have accounting gains not subject to a current tax charge. So we have an accounting gain that is not subject to a current taxation charge. And that's an example of a taxable temporary difference. We have delayed the payment of tax. So with deferred tax liabilities, we're talking about taxable temporary differences. We're talking about accounting gains which are not subject to current tax, where we're delaying the payment of tax. We're saying that the carrying value of our assets exceeds their tax base. We're saying that the carrying value of our assets exceeds the tax base. And the classic example is a revaluation gain. Now, can we take a brief time out here for a second? When I say revaluation gains, I'm opening up an enormous area of accounting because we have a mixed measurement system. So we revalue financial instruments, we revalue PPE, we revalue in agriculture, we revalue in group accounts on fair value adjustments. So there are lots of different scenarios where we are revaluing our assets and making our assets bigger. And strictly speaking, every time we revalue our assets, whether it's agriculture, investment property, financial instruments, PPE, strictly speaking, there's a fair value, strictly speaking, there's a deferred tax liability arising. But you would only account for that deferred tax liability if he asked you to. But it means that I think deferred tax can be tested for 2 or 3 marks in lots of different situations. So you can be a little throwaway kind of extra. Well, if we've got taxable temporary differences where there are gains giving us deferred tax liabilities, then there is a mirror image, yeah? Where there's a yin, there's a yang. So we talk about deferred tax liabilities, but we can also recap on deferred tax assets. So deferred tax assets come about when there are deductible temporary differences. And deductible temporary differences tend to be where you have accounting losses where we are not given immediate tax relief. And we talked last night about losses being carried forward, being an example of when we have a deferred tax asset. So accounting losses, expenses, where we are not given immediate tax relief. We have effectively here accelerated the payment of tax. We've effectively here accelerated the payment of tax. So that the carrying value of your assets is less than your tax base. The carrying value of your assets is less than your tax base. Or you can have the carrying value of your liabilities being more than their tax base. That will also give rise to a deferred tax asset. And the simplest classic example is an impairment loss. A write-down. Now, if we're going to be comfortable with deferred tax, yes, you need to do a little bit of rote learning. Deferred tax is provided for in full on all of our year-end tax, in respect of all of our year-end temporary differences. So we do need to have just a little bit of stuff that we can write down for a mark or two. But the way things are always examined is application. Yeah? And if you're having to go through the process of applying your deferred tax principles, you have to work out your temporary difference between the carrying value of your asset and the tax base. So step 1 is carrying value. Step 2 is tax base. Step 3 is to work out whether this is a gain, which is taxable, which is a liability, or whether this is effectively a loss, which is deductible, which is a deferred tax asset. If you're given numbers, it's almost a bonus. I'm just pausing for a second, just to make sure we're still awake on this lovely Monday morning. Last time I was videoed, I weighed a little bit more. I've lost a little bit of weight recently. Not a lot, I still need to lose a bit more. So I'll be interested to see how I look. Whether I've lost a bit of weight, I don't know. Whether it looks like I've lost a bit of weight. Or whether it will be further encouragement for me to carry on losing a bit more weight. In our notes, in part 3 of our notes, there is an example on page 64. So on page 64, we have here, and it's not an exam question, and it's not in a way in the style of an exam question, because all the question wants you to do is to compute. But I think we can cover an awful lot of ground by thinking about these 8 examples. And if you can actually compute these 8 examples, it will give you, I think, good practice or good understanding of how deferred tax works. So the requirement is compute the deferred tax arising at the year end. But Butcher has a tax rate of 30%. So the tax rate is 30%, and we have the following assets and we have the following liabilities with tax issues. 1, 2, 3, 4, 5, 6, 7, 8. Now, this is what I will want you to do. I will want you to take the information and make some quick decisions. Let us do the first one together. It's familiar, it's the easy one, which is why I'm doing it. And then as soon as it gets hard, I will leave it over to you. Scenario number 1. We own a financial asset. Could be an investment in shares. And it is classified as fair value through P&L, which means it must be a fair value on the balance sheet, and the gains and losses go to P&L. Now, we initially recognised it, and it has a current carrying value of 20, but now it has a fair value of 30. First decision. What's the carrying value, now that we know what's the carrying value in the account? Correct. Yeah, absolutely. The carrying value is 30,000. Because the asset is fair value through P&L, you must revalue the asset. So the gain of 10,000 is recognised in the P&L. Debit the asset 10, debit the asset 10, credit profit 10. We are reporting a profit. Tax base. Correct. The tax base is 20. Although for accounting purposes we have recognised the gain, for tax purposes there is no current tax assessed on a paper non-cash gain. So the carrying value is 30, the tax base is 20, and therefore the temporary difference is 10. We have recognised the gain. Is this a taxable temporary difference or a deductible temporary difference? It's a taxable temporary difference, yeah. So all I'm going to do is to say that is a taxable temporary difference. Some of these will be taxable, some of these will be deductible, and then we can add them all up, we can net them all off, we can add them all up at the end. I've done the first one, didn't spend too long doing it. Carrying value should always be fairly straightforward. The tax base, you're going to have to just think about it momentarily, but don't think too much. And then you've automatically got what the temporary difference is. 2 minutes, 5 minutes, there are 7 examples. Yeah, you've got to read the information, be decisive. Yeah, a few minutes, enjoy.